The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard. How you doing, Guy?
Pretty good. What's going on? I missed the Grand Poobah.
Grand Poobah. That's right. I'm the Grand Poobah of the Dillon Gage Company.
Hey, I did want to let you know that last week, got a couple calls, couple emails. People really enjoyed the show, so every now and again, it's good to get a good show out there.
Will they listen to our show?
I think so.
All right.
I'm hoping.
All right, to make sure. Remember, this show was designed to answer your financial questions. Anytime we get questions from a phone call, an email, from personal consultations, and we think it's going to appeal to a broad audience, we're going to share it with you. Before we do that, I have one quick story to tell. I was talking to one of my neighbors just this week, and they were explaining how someone else, I'm trying to keep it where I don't give away.
Identify the innocent. Dragnet.
But basically, they just bought their dream home. They're retired, and these are municipal workers, like policemen and firemen, stuff like that. And they had a pension. Pension was going to get them through. They had their dream house, just built a new kitchen, everything. Beautiful stuff.
Well, think about
Very
it now.
nice.
You work 20 years, whatever the requirement is, 25, 30 years. You know what the number is, right? We all know what the number is. You plan, you saved, you got it, you get the time in, you spend your money accordingly,
Right.
And then
They lowered the pension like 20 or 30%.
retroactive.
That's right. Now they can't pay the mortgage. This happens all the time, and it just makes me mad. Nothing can make me madder than somebody promising me something and giving me 30% less. And by the way, unfortunate part about some of these pension cuts, the biggest example I know is Detroit. You know, they cut some of their pensioners 30%.
And
Go ahead.
I was going to say, I think an important thing to note too, perhaps, is maybe can't pay the mortgage is a little bit harsh. Maybe they can afford the mortgage, but they just
Can't go out to eat.
Yeah, they can't have any entertainment, so they're doing the smart thing. They're making the hard decisions and the hard choices. But you shouldn't have to do that after serving your country, serving for 30 years.
Right. And they're having to sell the home, move into a cheaper home, not because they were living outside their means.
Exactly.
It's because their pension was cut after they were promised this pension for 30 years working for this particular municipality or whatever, and now they're not getting it. But what it does, it reinforces the notion that there's only one person going to take care of you. There's only one person you can count on when it comes to your retirement, and that's you. And that's why you have to make informed decisions, because just trying to wing it, if the stock market makes 8% a year, I'm going to be fine. As long as Social Security keeps increasing and never gets decreased, I'm going to be fine.
I think we'll all be fine.
That's
if
right.
Those two things
As long as my
happen.
pension
Woo!
doesn't get cut, I'm going to be fine. You can't have a retirement based on what the stock market will or won't do, what a pension will or won't be cut, or anything else. You've got to base it on solid guarantees. And that's why our philosophy here at Dillon Gage has always been and will always be, at least pay for your hard expenses with a guaranteed check. A guaranteed check that's not based on the municipality's finances. It's not based on the government's finances. It's based on huge reserves and the biggest regulations you'll ever see. In other words, I've never heard of these payments going down ever. And so that's the kind of thing that you need. Your income has to be based on something that has nothing to do with the government. It has to do with you. Now, don't get me wrong. The government paying all that stuff, you can count on a certain percentage of that if you wanted to. But trying to close a blind eye and saying something can never be reduced, that's attached to the government in any way, that's just, you're turning a blind eye and not facing the reality of what could happen to you.
Yeah, and adding to the fact of not depending on the government, I know right now there's a lot of political uncertainty with the elections and all the bickering. No, there's a lot of financial uncertainty with the market being in one of the largest bull markets ever. Everyone's just waiting for something to happen. It doesn't happen right now. The U.S. stocks seem to be a safe haven. All sorts of money's coming in. That's helping. The Fed is helping the market. But don't let, and I want to emphasize, don't let this political uncertainty postpone your plans for taking care of your retirement. What I mean by that is, however old you are, whether you're 60 or 65 or 55, your retirement isn't changing. Your date is still your date. And the time value of money, the sooner you can get something like this in place, the larger your pension will be, or the less money you'll need to put away now to get that same number later. Don't let all this minutia going on in our country today stop your plans from retirement.
You have to have, that's why it reinforces also you have to have a written retirement plan. And that's what we do here is we do a written retirement plan that shows you, okay, what if inflation is this amount? What are my expenses going to be when I'm 60, 80, 70, 80, or whatever? All right, what are in my investments, if the market doesn't cooperate, am I going to be eating cat food when I'm 80? Am I going to have to move into a one-bedroom apartment from a four-bedroom house? It'll address all of these different issues for you. And there's another one that comes up a lot. I've spoken to 2 people in the last 2 weeks that planned on going to 67 for retirement. They weren't going to start their Social Security at 67. But at 62, one was 62, one was 64, they were forced out of their companies. And they said, well, I think I'm going to try to get a job to bridge that gap. Well, good luck. A huge percentage of retirees that retire early are forced into it. I told them, I said, all right, what happened at your company? Well, there was a takeover. They brought somebody younger, and I was training for a year. I said, you trained your replacement, right? He goes, that's exactly what I did. Not knowing it, but they replaced it. Because they think about it. They got the older guy, cost him X in insurance. All right? And the younger guy cost them a lot less in insurance. The salary's a lot less.
That's right.
All of these different things, and they start replacing. Even though these companies know they're losing a knowledge base that they can't replace. It's bottom line, especially when these numbers guys get into the financial part of the company. It's just numbers to them. And so they'll start cutting you, and good luck finding another job, especially with a small business.
Well, they don't want to hire us for the same reasons, right? The insurance is more, and the salary should be more.
I mean, I remember when what was I? Oh, I think I might have been 40 or 30-something at the time. When I think it was 35. And Payne Weber, if you remember, was talking about hiring. And they had a real problem hiring a 35-year-old at the time because they want somebody they can mold. They want an Ivy League guy right out of college. They still offered the position and all that kind of stuff. But you imagine, now bring yourself to 62. Even though you got more experience, your temperament is better. You're 10 times better than an average 35-year-old. They still don't want you. So when you're doing a retirement plan, you've taken into account these kind of potential outcomes. Okay, we've got your retirement plan. You're going to retire at 67, but here's what happens if you have to retire early. Here's the adjustments we can make to this plan. And so remember, if you want to take advantage of a free, no obligation retirement plan, written retirement plan, stress test, Social Security optimization, don't hesitate to call our hotline. It's 972-715-2424. Again, 972-715-2424, or you can go to ilovemyretirement.com.
Think about it for a second. We always say you plan for the worst, so you're prepared and you're covered, but you expect the best. How does it feel if your income is handled in retirement? You know you're going to get what you need to get. Now you don't have to worry about the market. If the market goes down, you have your income. If the market goes up, like you said, you anticipate the best, you just have extra funds, whether you want to pass them to heirs, help the grandkids. It just postures you to be in the best position.
Every single week I see people, 90% of people don't have anything written down for retirement plans. But everybody knows out there, I used to be a nuclear chemist. So I get a lot of engineers and doctor type, very analytical, a lot of accounting type. And sometimes they'll come up with a plan. And sometimes they're based on 6% minimum return, 8%, 10% minimum return.
Right.
And I said, your retirement plan can't be based on what the market will or won't do. It has to be based on something else. If you could base it on a low return, 0 to low return, you can live with that. In other words, you're not going to go broke no matter what for the rest of your life, even if this no return. Then if it does make the average return or better, you're going to be ecstatic.
I tell you what, a lot of those life guys will give you illustrations. Bank on yourself at 8% return, and they don't mention the cost of insurance, and the numbers look great. Got to be careful.
Yeah, just got to look at everything. We're very analytical here. There's 2 approaches to financial services. One is the sales approach. We're going to sell you. It's only good till tomorrow. You better sign up today.
Hurry.
Oh, hurry. Oh, don't listen to those guys. They're terrible. This is the only way to go. or there's the analytical approach. We typically like the analytical approach. I'm going to show you a bunch of different reasons why a certain strategy should be considered.
Now,
Not just a sales pitch. Here's the highlights. You've got to do those kind of things. You've got to you do your research on every investment, every advisor that you ever come in contact with. If you'll do that, and then your retirement's going to be a much smoother ride. Go ahead.
The downside with working with these engineers is you have to model, do 84 illustrations, and 8 months later, you've got a good client.
Now, they're the best clients in the world.
No,
because
they
what
are.
happens is, once they do their analysis and they prove the same things that you've proven already, they are loyal clients forever.
That's true.
Because everything is logic-based, not emotion. They didn't do something on the spur of the motion. So remember, if you'd like to take advantage of that, don't hesitate to call our hotline at 972-715-2424. Again, 972-715-2424. We're going to answer your questions right after the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
That's right, common sense. If you think about it, if you boil things down to their common sense components, it makes it where it's more difficult to make bad choices. If somebody tells you, we're going to give you zero risk, 10% minimum return, blah, 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 what's the catch, right?
Well,
common sense dictates that's not reality.
think about it. How many extremely smart, well-educated people do you know that don't have common sense and make bad decisions? And we'll leave politicians out of it.
Well, senior scams is a big deal.
Oh, yeah.
People get scammed, and these are educated people. Get scammed all the time from somebody calling them on the phone and trying to sell them some garbage.
And understand the people that are calling and trying to sell, they're practiced. That's all they do every day. They're prepared for what you're going to say. They're prepared for your questions. They're highly skilled.
Oh, they've got a whole script that says, if no, this. If they hesitate, this line. They just spit them out, and they become very good at it. And so it makes it tough to determine what is legitimate and not legitimate, but just always put your common sense hat on.
And
that'll save you a lot.
The longer you stay on the phone with them, the odds go way up of you getting in trouble. Don't stay on the phone with them.
Remember, this show is developed to answer your financial questions. So, Guy, what's our first question?
All right, question number one. I was a homemaker for many years and then got divorced. Can I collect on my husband's Social Security?
I am no Social Security expert, but yes, you can. Basically, if you were married for 10 years minimum, 10 years, and you haven't gotten remarried,
that's right.
You can collect the spousal benefit on your ex-spouse's Social Security. Now, what you have to do to determine if that's a way to go is look at your own Social Security benefit. If you don't have one, obviously it's a good deal, right? But whatever your own Social Security, then you take half of your spouse's. Because in many cases, especially if you're an older couple, one spouse made a lot more than another, okay? So that spouse, you can take half of their Social Security. Now, all you ex-spouses out there, it does not affect your ex-husband or ex-wife. And they'll still get their full Social Security. You would just get a number that is half of their full at your full retirement.
Not that it would bother you to take it if it docked in half if you're divorced. But I think you can also take that a step further if you had a postal worker as a spouse, or you're entitled to part of the pension, and there's many other things that
it depends.
that go that
Social
way
Security, I'm not as familiar with the pension stuff because some of them don't. They're actually
you
eliminate ex-spouses.
Well, you have to deal with it at the time.
Right.
You can't go back 10 years.
The reason is that they don't want to be unfair to. Let's say you were a homemaker that raised your children, and your husband went through medical school. You supported them all through medical school. Well, you should get some benefit of that Social Security too, because you contributed to that particular relationship and that financial situation. So therefore, you should get part of it. So the spousal benefit is typically half. Now, it's half of their full unless they take it early. And then it can be half of their early. Or if you take it early, you can take the spousal benefit, I believe, at 62. But it'll be half of a 62 number, not the full. So those are a few questions you can ask your Social Security office. But you absolutely, if you're married for 10 years, not remarried, and you can definitely claim a spousal benefit on Social Security.
Yeah, and if you get remarried, then the whole situation applies again, 10 years, and if you're not remarried from that marriage, and
just make sure you don't marry somebody that's broke the second time. because then you get their crappy Social Security now.
Well, if you married someone really old, it might work in your benefit.
That's right. Now, if you got somebody with really good Social Security, hey, babe, I'm not saying that's the only reason you marry that person.
Not that that's a question you should ask before you get married.
That goes into the queue, though, right?
That's right. You ready for another one?
Yeah.
All right, here we go. I'm about to inherit a bunch of stocks. How much taxes do I need to pay? How does that work?
All right. With stocks, when you inherit stocks, now this is not everything that you inherit, but when you inherit individual stocks, not mutual funds, not ETFs, individual stocks, you'll get a stepped up basis. So let's say your parents, this happens a lot. Parents had this ExxonMobil stock, to use an example. They got it at $10. They used to work for them. Now it's $100 a share or whatever. Well, you'll only pay from the basis from the time of death. So even if you took a year to get the money because of the courts and blah, blah, blah. So they had $1 million in this stock. You're only going to pay anything above the $1 million past their death. You don't have to pay. It's called because you stepped up the basis to $100 a share in this case.
And you can do an alternative adjustment up to 6 months too on that, and spouses with homes and all of that. So
yeah. So now, if you inherit an IRA, you're going to pay full taxes on your tax bracket. If you inherit life insurance, there are no taxes on life insurance proceeds unless it was a company plan where the company paid the premiums. If the company paid the premiums, the death benefit is taxable. And so there's all kinds of issues like that. It gets complicated. If you're going to inherit a big amount of money, be sure you hire a good accountant because you're going to want to mitigate the amount of taxes you pay as much as possible anyway. And some things like IRAs, you can actually delay the taxes up to 5 years when you're paying taxes on an IRA or something like that.
And we do this every day, and even we use estate planning attorneys and all of that to sort through the larger, more detailed cases just to make sure all the T's are crossed and the I's are dotted.
Yeah, if you are about to inherit money or have inherited money and you have any questions like this, don't hesitate to call us at 972-715-2424. Again, 972-715-2424. And there are some ways. Let's say you're a senior, you're in bad health or something like that, and you want to allocate your finances in a way to make the transition smoother to your heirs. There are resources that we have available that can help you there too.
Transfer of wealth.
That's right, 972-715-2424. Or you can go to ilovemyretirement.com. I have people call me all the time that say, I'm going to inherit this money. I go, when do you think? I don't know. They're not looking too good last time I saw them.
I've had estate people in the process. The death, unfortunately, has taken place, but a relative is the executor, and they're in no hurry to distribute everything. It can be a mess.
It's usually the executors got with money, and the other ones are broke, and they're like, oh, we need the money.
Yeah, no hurry.
Well, we got a break coming up, folks. Stay with us. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
That's right. We're the kings of something.
It's good to be king.
All right. Today we're answering your financial questions. Remember, if you have any financial questions, or let's say you've heard about this particular investment, or you've got some information, and you want somebody to really dig down this at no cost, no obligation, we'll show you the pros and the cons, not just the pros. We're going to show you the good, the bad, and the ugly, and we do it at no cost or obligation to you. And it's 972-715-2424.
And I would add, there's always been commercials. Certainly, we run commercials and spots to get people in and get an opportunity to work with you and meet with you. But there seems like there's so much right now. There's 3 or 4 annuity guys running all the time. I've seen REITs now running all the time.
Gold, silver, hard assets.
Silver and hard assets. You've got bank on yourself. I mean, it's a mess, and I think what it drives a lot of our listeners to do is nothing. It's just easier, and it gets confusing, and they're using fancy terms, and I'm going to stay where I'm at.
Somebody told me the other day, they said, do you guys just do annuities? Because all I hear is annuity commercials. I go, well, if you look at the laws, when you have to equally weight each thing, and you have to have full disclosure, you have to recite a prospectus if you want to talk about stocks or bonds.
Securities, that's right.
So that's why you don't hear, this is the greatest mutual fund ever. This is the greatest stock plan. It almost makes it illegal to ever mention stock stuff on an ad. So that's why, even though we've done stocks and bonds way longer than we've done anything else, that's how we get business sometimes, is doing commercials on something you can actually do a commercial on.
And commodities and managed commodities. But think about it, even the money managers, and the big one that you hear out there, they don't tell you how good and the returns and that you need to have them manage your money. What do they tell you? Oh, if you're looking at annuity, call me. Well, that's because there's too many rules and regulations. They don't want to talk about the securities.
That's it. They don't take any of it. So that's why you'll see even people that do securities as their main focus, you can't really do ads on anything else. So remember, we've been doing every type of investment for a long time here at Dillon Gage, since 1976. Our average experience of our advisors is over 20 years each. You're not going to hear this. We have combined 80 years experience in our office here. What do you got, 20 guys?
Oh, yeah, and you got 80 guys with 1 year, right? Each.
No, it's 20 years each. Our advisors know how to handle investments and know what to look for in good markets, bad markets, high interest rates, low interest rates, and everything in between.
And it's not just book knowledge, not to interrupt
That's right.
you. We've been through the up markets. We've been through the down markets. And when people ask me, is the market going to go up? I tell them yes. But it's also going to go down. You can count on that. Do you know when? No.
I mean, think about if you had an advisor at a big firm, because a lot of people like big firms. Our managed money is at Fidelity. I like big firms too.
Absolutely.
I said, but you got a guy, it's an Ivy League, 25-year-old Ivy League guy. He's got a master's degree in business. Sharp as a tack.
Drives a Mercedes.
That's right. So theoretically, they're a pretty smart guy. They have zero practical knowledge, experience, nothing. And so they're basically learning on your money. And I don't know about you. I don't want somebody learning on my money. I want somebody who's already gone through the bad stuff and already learned what not to do. It's not only what you should do in investments, in finance. It's what you shouldn't do that is even the most important. Just think about it. Call us if you need any financial questions at 972-715-2424 or go to ilovemyretirement.com. All right, Guy, what's our next question?
All right, next question I'm familiar with because I got the question, and I would preface it with this. This individual is a sharp individual. He's a PhD. And I say that to say this. It's not a PhD in economics, obviously. You can be sharp out there, but if it's not something you do every single day, there are no dumb questions. So here's what the question was. I heard a very influential national advisor explain that converting an IRA to a 401k
or 401k, right?
Yeah, or 401k it's my question. What happened? Or a 401k to a Roth is the best thing that you can do to avoid yourself from future taxes or to get a tax-free retirement. I remember you saying that converting is a bad idea for most people. Could you explain the reason again?
Well,
damn, that was a tough question. Holy cow.
Don't do your questions anymore.
I'm not going to do. You do it next time.
The basic thing is there's a lot of advisors out there, and honestly, they're really not advisors. They're consumer advocates. And they say you should always convert a regular IRA to Roth IRA. I see this almost every day. I've got a doctor came in my office and said I had this $1 million IRA and I converted it to a Roth because that was smart. I want a tax-free retirement. I don't want your taxable retirement. I said, okay. But when you take a pen to it, remember, this is all math. Everything else is a sales pitch and possibly BS.
It's analogous.
Math.
It's the same.
That's right. Math says if you have $1 million regular IRA and then you convert it to a Roth, and say you're in the 30% tax bracket, you do $700,000, growing tax-free, $1 million growing tax-deferred. Let's say in 10 years you made 7% on the whole thing. So you'd have $2 million in the regular IRA, $1.4 million in the Roth. You pay 30% tax if you're in the same tax bracket at retirement, you'd have the same $1.4 million. The government didn't give you anything when they came out with Roth IRAs. They got a way to get 30, 40 years of taxes up front.
That's right.
Okay? Now, what if you're in a lower tax bracket at retirement? You're just taking this IRA and taking $30,000 a year out of it. Well, you might be in the 10% tax bracket. So if you're in the 10% tax bracket, your regular IRA is much higher. And my point there is, if you're in a lower tax bracket at retirement, a regular IRA, regular 401k is way better for you mathematically. I'll explain more after the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Today we're answering your financial questions. If you have a financial question, don't hesitate to call us. If you've seen any kind of advertisement or heard someone on the radio or television and you'd like more information, really like the pros and the cons, a detailed analysis of that particular product, don't hesitate to call us. It's not products we offer. We are familiar with just about every kind of investment out there. It's 972-715-2424. Again, 972-715-2424, or go to ilovemyretirement.com.
Which means we try to be objective, right? Not subjective on it. I'd add to that question. I know we were finishing. We were just talking before the break about should you or should you not convert your 401k or your IRA to a Roth, and there are advantages and disadvantages. One of the questions that came up, it was actually a conversation I had with a fella. He said, well, what if I wanted to take $50,000 or $60,000 out and, do something with it, an emergency? And I tried to back through that a little bit and explain to him that, 401ks, when they were developed, were really corporations' way of shifting the liability. They used to do defined benefit, where your benefit was a pension, you knew what it was. They shifted that to defined contribution, defining your contribution for high-paid, high-salary people, but then the whole thing shifted to us. So it was really intended to be a pension. It's meant to provide an income and to supplement, and kind of like Victor going through the numbers between $1 million in a traditional or $700,000 being the same in 10 years at the same growth rate. It's the same thing when you're withdrawing it. If you have an emergency, let's say you needed $60,000 for something, you really need to be able to use your non-qualified, because that $60,000 is going to cost you $100,000 if you take it out of your IRA. It's really not designed for lump sum. Why? Because you take $100 out, it's $100,000 of income that year.
Added to your existing income.
Yeah. So then assuming you're in a 40%, if you're in a 30% bracket, you net 70. So it costs you $100 to get 70, where the non-qualified, if you need 70, you take 70. So if you're in the position to, the non-qualified is much better for lump sums than the qualified money.
Well, I have the, now sometimes I get pushback on it. Remember, I'm an engineering type. It's numbers to me.
Yeah, it doesn't matter. How do the numbers look?
Numbers are the numbers. But they'll say, no, Victor, you don't understand. I know taxes are going up. This person is a really hardcore Republican. They said the Democrats they're getting in there. They're going to raise the taxes. I don't want to pay any taxes yet. I'm not going to pay. I'm not going to be subject to these tax increases. But the truth is, if you're making $200,000 a year in retirement before retirement, and you're only making $50,000 after retirement, the odds of you being in a higher tax bracket are astronomical. Even if they raise every tax bracket, you'll still be paying lower at $50,000 income than at $200,000 before. I've never heard that switch, right? So if you do the math on it, if you know you don't have a huge income, I mean, the paycheck stops and you're just taking money out of retirement accounts and Social Security and or pensions. If that's going to be considerably less than when you were making a paycheck, then obviously a regular IRA always makes the most sense. Now, when does a Roth IRA make the most sense?
Well, let's think about that. What if you have a pension, you've got good Social Security, you really don't need to take that 401k money and supplement your income? If you transfer it to a Roth, you're not required to take required minimum distributions,
There's one.
And you could pass the whole money to your heirs.
Tax-free. That is correct. If you're going to pass all the money to your heirs, you're protecting them against tax increases, things like that, if they can take, because even though you might want your heirs to take an income off of amount of money you give them,
stretch the IRA.
99% of every inheritance dollar is spent within 18 months. 99%. It's pretty high.
Yeah, we see that happen all the time. And you can't
I need a new boat. Now I got me a new trailer. I got the whole thing. So tax planning is really important, but you got to make sure you're looking at through the right lenses. Don't get emotional like, I hate the IRS. I hate the government.
I don't want to ever pay taxes.
I'm never going to pay taxes. And somebody says tax-free. Tax-free is not always better than taxable, even though that's hard to fathom. It depends on what your net is. If the net after tax is better than tax-free, I'm taking the net after tax. Okay? All right, what's our next question?
Oh, you caught me asleep here. I was listening.
Are you going to be able to read this one here?
Yeah, probably. No. All right. My advisor keeps pushing international stocks, and I tell them that I don't want to take that much risk. Is there anything I'm missing? All
right. There is the common perception that U.S. stocks are the safest in the world. Foreign stocks are the most risky. The last 10 or 15 years, I think it's pretty much been true.
Yeah, if this is a current question, I would get rid of your advisor. Just saying.
But the truth is, American funds probably did the biggest study on this. And they said a combination of 35% international stocks with your 65% U.S. stocks actually gives you the highest potential return and the lowest level of risk. Now, it has been skewed a little bit with because the world's kind of crazy right now. It's kind of crazy. So, but historically, that has been the fact.
And that
adding international does help your portfolio.
Yeah, and I just would add for clarity's sake that 35-60% allocation international and national, our stuff, domestic, is of your stock allocation. It's not of your whole portfolio.
Right. If you do that, so usually, now I'm not talking about a bank in Paraguay. I'm talking about big internet, Toyota, Mercedes, big international companies, because I'm not a big fan on developing markets, even though they could return the most potential.
Oh, boy.
International companies kind of scare me unless they're big. And there are some huge international companies that are definitely okay to invest in. Now, when it comes to international companies, I will go with a fund or ETF instead of an individual stock because I don't have the research capability of really researching a company over in Germany as much as someone else might. So that's what I would use with those particular ones. All right, what's the next question?
All right, next question is, I don't need any future income, but I'm trying to get more yield on my safe investments. I've heard you talk about fixed annuities, and I've heard that they're no good. Why should I consider them?
That's a good question. We're going to have to answer it after the break. We got a break coming up pretty soon, but we're going to answer that question. If you have any financial questions, don't hesitate to call us at 972-715-2424. Again, 972-715-2424. We'll be right back after the break. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Right before the break, we had a question. Why don't you read it again, guys?
One more time. We're answering your questions today. This question was, I don't need any future income, but I would like to get more yield on my safe investments. I've heard you talk about fixed annuities, and I've heard that they're no good. Why should I consider them?
Honestly, it's just interest rates. That's why I would consider them. Now, there's several types of annuities. Make sure if you're talking about just a higher yield on a safe investment, you don't want any fluctuation. Like an index annuity, it gives you the most potential on a safe investment. But if you want the most guarantee, you can get like a straight fixed annuity, maybe 3%. I never thought in my lifetime I would say, hey, look, 3% is great.
Oh, I know.
But think about it. 10-year bonds are paying 2%. They have risk, right? You've got interest rate risk, default risk. 5-year CDs are paying 1%. I think 10-year treasuries like 1.2, 1.4. 30-year treasuries are 2.5.
Everyone's seeking yield right now. That's why the market's doing as well as it is.
So that's what you have. Fixed annuity, they're called CD-type annuities. Very similar. They just pay interest. Remember, like I said, an index annuity is for somebody that wants more potential than 2.5 or 3, but still wants the safety of a CD-type investment. A straight fixed annuity, MYGA is the only one you should do. Don't take those high first-year yields. We're going to pay you 5% this year, and we're going to float the next year. Trust me, you'll never make more than 1 for the rest of your life in that thing.
It's an adjustable rate. And
we get 3 for life, get that one.
And we always try to share with you, as our listeners, you really don't want to shop products. Again, going back to all the commercials you hear about gold and silver and annuities and REITs and all of this stuff, it's real tempting to shop products. But if you're looking for yield, if you're looking for security, come visit with us, chat with us on the phone, and we'll just show you what your options are. Term-wise, year-wise, yield-wise, you make the best decision, what works best for you. Again, Victor and I always say it's just about the math, so it's a simple process.
All right, Guy, what's your next question?
I don't know. Let me look. All right. How do I know that I'm fully diversified in stocks and bonds?
It's difficult sometimes to determine whether you're fully diversified or not. Fully diversified would mean having all the different sectors of a market and international and alternative and fixed income.
And then you got to balance the diversity.
That's
you
right.
Can't let one sector get too large over another one.
You're going to have large cap U.S., mid cap, small cap, micro cap, and then the individual sectors within those. And that's why to get fully.
Do I need to be fully?
Right. Not always.
Right.
Now, what is one of the best ways for you to do it yourselfers to get fully invested? Well, something like the Vanguard 500 Index, Vanguard Total Market Index.
VOO's the ETF version.
They're going to have like I'll give you an example. Everybody mistakes that the S&P 500 is the 500 largest companies in the United States. It is not. It's 500 large companies that represent all of the different industries in the United States.
Oh, it's close.
It is. Most of them are in, but there's a few that are not in there.
That's giving you a hard time.
But that's true. So that is a good way to diversify on your own. Otherwise, if you're doing individual stocks, it's going to be tough. You might want an advisor, or you're going to have to do a lot of research. But some of you guys aren't, allergic to research, so it's no problem.
We talked about that a lot too, Vic, that one of the biggest advantages of an advisor, other than hopefully someone that's got experience and shares your philosophy and all of that, but one of the biggest things is it takes the emotion out of it. If it's your own money, it's your own money. It's your life savings. If it goes up, woohoo. If it goes down, no, you kind of avoid a lot of that.
I think that goes into our next question, Guy. What's the next question?
See how I am? Okay. Oh, this is a good question. Should I use a robo-advisor?
There's nothing wrong with a robo-advisor for sometimes setting up a portfolio. The one thing they're going to have more difficulty in is life changes that might happen to you. I'll have an example. I'll have a lot of people that I know are do-it-yourself advisors or investors. Nothing wrong with that.
No.
But what happens is their spouse has nothing to do with investments and really no inclination to want to do them. And so sometimes having a real advisor instead of a robo-advisor is a help to them. When your situation changes, I'll give you an example. Typically, when someone comes to my office, we have to gather information. And we're going to work on this information with our paraplanners and everything for a couple hours to input everything into a plan. I'm going to spend 3 or 4 hours outside of that trying to devise a plan and strategies to protect their assets. So we're talking about 6 hours, and there could be 3 to 4 hours of meetings in there, so 10 hours. Yet a robo-advisor knows nothing about you, nothing about your situation, your expenses, or anything else, and they're telling you how to allocate your assets.
What?
It's the same thing when people transfer assets. I remember this one case was very difficult, and basically we're going through the whole thing, and it spent about 16 hours working on this. And they were trying to transfer out of one big firm. And they go, well, the transfer people said this is a terrible idea.
Oh, yeah.
They told me that they should do this. And I go, so they've never heard of you, have seen you're a number on a computer, and they gave you advice on something for the rest of your life, not knowing your objectives, your risk tolerance, or anything else. They didn't do this background work. They can't give you advice on anything. Yet people take that advice sometimes. So the difference between a robo-advisor, an advisor that doesn't know you, there's a big difference. Does that say you can't use them? Of course you can use them. And sometimes they don't do a bad job as long as the market doesn't give them too many hiccups. I'll tell you what, if you came in 2009, a robo-advisor and a regular advisor, probably performance-wise is similar. It's when the market goes down or it goes into difficulty or something happens in your family that changes, that's when the robo-advisors have no idea because every person's different.
And all it can draw on is statistics from the past.
That's exactly right. Things change. People change. You have to be able to adapt to those changes, and that's what a real advisor is. If you have any questions or you'd like to ask us any questions or like to take advantage of our no obligation, no cost retirement plan and stress test, don't hesitate to call our hotline, 972-715-2424. Again, 972-715-2424, or you can go to ilovemyretirement.com. I'm Victor McClure for Guy Allert. We always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice